Hey, thanks for joining us, everyone. So, like our introducer just said, my name's JJ, and I'm a principal at Side Door Ventures, which is a generalist multi-stage fund in Canada and the US. So, really excited to be talking to you guys today about alternative data, and in particular for the underwriting of consumer loans. So, we've got a fantastic set of panelists here today, and would love it just to kick things off. Let's set the stage for the audience. So we'd love it if you guys could maybe talk a little bit about some of the problems that traditional lenders have lending to underbanked consumers, and then define what alternative data is in the context of lending.
Yeah, sure. So I'll give a bit of context. So given the way that a financial industry has developed, right, we've seen that the penetration of the banking services have been around 50% around the Latin American region. And so that has provided a lot of services to a good portion of the economy, but a lot of that has been left behind. And so the players that have been currently in the industry have leveraged what it's called traditional data points, right? So that means data points that they could get from the credit bureaus, and that usually is about what's their financial income, what expenses do they have other types of loan in the market, and that's the way that typically the creditworthiness of the people have been determined. And so the other side of the coin, which has been this sort of boom that's been happening, is how to use alternative data points in order to determine the creditworthiness of a person, right? And so I think that the three of us here on stage have a very different view, not very different view, but a different way of leveraging the alternative data points that we each use in order to determine the creditworthiness of a user. And it's interesting to see how that differs company to company, right? So if I'll give a jump start to how we use it in Vana. I'm pretty sure Augusto and Ido can share how they use it in their companies. But in Vana, we started to see that given that users don't have a way for them to be validated in the financial industry, that you could use the phone as a proxy in order to understand their behavior and the likelihood that they're going to pay a credit or not, right? And so when we started out Vana, we saw that we were able to capture more than 1,000 data points per user in order to validate them. But the data points tend to be untraditional, right? So a few of those, just to give like a bit of context, would be the way that users save their contacts, right? So in Guatemala, there's this typical way of referring to people, which is using don or doña, right? Which is like a term that would equivalent to miss or Mrs. when you refer to someone. And using that data point is something that if a user saves a contact in that way, tends to show a lot of respect to authority, right? And so like that's like one data point that we capture out of 1,000. And so that's something that we begin to see in the phone. Also, the way, how fast, for example, they fill out a form tends to be a bad indicator versus somebody that fills out the form, which is a bit more precautious and reads all the terms and conditions. And so that's what we saw in the algorithm that we began to develop in order to understand the users and provide them a credit that they would otherwise not be able to capture given the limit that they had in their credit history. So that's a bit of sort of Vana and sort of what it is to use alternative data. And so I think Augusto can share a bit more on his side.
Thank you, Tito. Yeah, well explained. So alternative data is here to solve the chicken and egg problem that we have in the traditional financial market by providing more information that is not based in financing, right? In credits. That will help to bring many people on board in the financial system. But we need to make it cheap because most of them are in the long tail part of the financial from the economy, so they don't have a like large capacity or payment capacity. So you need to do it in a cheap way, so it's affordable for us as providers to serve those customers. In the Stacame, what we do, we think about financial inclusion not only by how people access to a product, but also how they access in an informed way, like responsible way. And in order to do so, we provide also education and financial tools to set behavior. So what kind of data that we use, which is a type kind of different, in Mexico, for instance, we operate in Mexico and in Chile. We have more than 4 million users. And the way we do it is we see how people interact with the information and the educational tips that we send them through the email, and how they use the platform and interact with the content to create variables that we set and we add into our models. Those variables are even more predict better the behavior of credit repayment than what we get from the bureau. So that's one example. In Chile, we use, for instance, how people repay their utility bills. So how you repay your water, electricity, and gas bills are a type of microloan. And the way you use and you pay that will set how you behave in your loans, and it's quite predictable.
So it's wonderful what both of you are doing. And when we looked on the market before even to start technology, we wanted to understand what is the problem, the major one, and we saw that in emerging countries, 70% of the population not really have credit history. And from the one with credit history, only 10% actually get approved from the legacies. So if you do the math, it's around 5% of the population actually get services. And of course, as a society, as a neighborhood, as a GDP, it cannot continue like that if the country and the people want to grow. So what we did, we thought, or we start our way on thinking how technology can help, but from the other hand, if we don't have any information about the user, because this is what exists, no information, and we don't want any private information. Regulation and compliance have a lot on privacy. So we looked on the market and we saw that a lot of companies use alternative risk scoring, or by questionnaires, or by smartphone detection, or by behavioral analysis, and they need to collect a lot of data points, and we want to change a little bit the paradigm, and we said that maybe we can do that only from a single point of data that usually exists in the company. And what we discovered, and it took us 5 years to do that, PhDs and very talented people, we discovered that our looks, face for example, have a lot of biological indicators, and our behavior also depends on biology. So if we know how to read biology from the appearance, we know how to predict behavior about the user. So what we are doing now, we don't take any private information, and we take the selfie that's kept in the company. We do only extracts, biological indicators from the face, today more than 2,000 biological indicators, and only from that, in 3 seconds, give back to the companies, because we are not B2C, we are not lenders. We give the technology to Vana and to the others one. In 3 seconds, we give the score, the probability of the user to pay back the loan or to do a fraud, and by that we increase the number of customers to the company in around 4.5 times. So this is for us.
Awesome. Thanks for giving everyone a great introduction into alternative data. So next question I've got for you guys, we'd love to dig into a little more on how you develop these models. You know, Cristobal, I think when we were chatting earlier, talked about how you guys use over, hundreds and hundreds of data points. And so some of them, that you've talked about, you're like, cool, payment history of utility bills. It's, it's one step away from a credit card. That, some of those data points make sense. But then, some of the other ones, like I thought it was really interesting, and we were talking about this earlier, you're like, oh, if someone is putting in formal honorifics in their phone, maybe the signals maybe the signals that they're a more organized person or more likely to sort of repay their loans. So, some of them like that I think are a little less obvious. So we'd love to just, we can go around the circle and learn about how you guys are able to figure out what data points to look at, how you develop the models, and then how you validate them and sort of bring them to market.
Definitely. So I think it goes back to the roots of how we started Vana, and I think very important that for these algorithms to be built, they have to be built on data points, right? So it's important that the algorithms are based on good data points and bad data points. So it means that for you able to have an accurate algorithm to really determine the credit risk of someone, you have to understand what a bad debt is. And that's something important that you have to detect while you're building your algorithm. And so when we started out, we basically started with basic loans where we weren't even filtering, right? We call that giving blind loans and simply offering to people and basically understanding the behavior behind people who do pay and the people who don't pay. And so when you begin to capture that data, you have a lot of room to explore and understand what type of variables are definitely of significance in order for them to determine the credit risk, or what other data points aren't that significant. And so I'd say that from when we started out, we've been iterating almost on a monthly basis, launching new models, right? In which we are able to, with the more data that we have, keep fine-tuning these models, right? And I think one of the interesting that we even saw was, given that we operate right now currently in Guatemala and Dominican Republic, the variables, despite the fact that the countries are not that far apart from each other, really differ from one country to the other. And so it's really important for you to take a very local eye towards the user that you're evaluating, and at the same time keep it iterating with all the data points that you're capturing throughout the history of what you're repaying. I think very important for you to have a very solid data science team, which I think all of us three can agree is critical for you to build these models, and the constant iteration that happens right behind it.
Yeah, just quick to add is it takes time, a lot of time, a lot of mistakes.
A lot of money.
A lot of money because you have to test and mistakes as well. And also it changes because, for instance, for the first loan, you have some variables that predict better than others, and while the person keeps asking for new loans, the variables also changes. So it's not only changing the entry model, but also all the modeling that is afterwards. So we help people to get to larger loans and better possibilities.
Awesome. Ido, anything you want to add there?
Same.
Cool. That sounds good. So next thing would be really curious to hear from you guys. Would love it if we could kind of dig into some of the, kind of some concrete real world examples of how alternative data is able to promote financial inclusion and, get more consumers banked, help underbanked consumers, promote greater access to sort of financial services. And would love it if we could just riff on that for a little bit.
Yeah, definitely. I'll share a bit of sort of the use cases that we've had. So if you see, Guatemala has the majority of its economy in the informal economy, right? That means that it's basically managed through cash. And you have on the other side a lot of entrepreneurs, right? They're self-employed, they have their own mom and pop shop, which they manage to transact, right? But with cash. And so with Vana, once they are able to apply, we use those data points in order to determine the likelihood of payment of this person, right? And with that, we're able to give a personalized offering in terms of amount and the interest that we charge for that specific person, given the risk that the algorithm determines behind that. So I think that the interesting thing that we've been seeing of how alternative data really pushes forward financial inclusion is by the fact that you're able to offer a lot of credit to people who don't have bank accounts, that don't have any type of credit history, and just manage their day-to-day with cash, right? So this is a way for them to really validate themselves against the financial system, and at the same time begin to create a credit history. And so we see ourselves as well as their first time credit history being built with us through the data points initially, and then afterwards to the repayment history, right? And so that's sort of what we want to keep promoting, and alternative data is that first sort of jumping point for us.
We need to remember why we do that in the beginning, even before we start to develop something. So the alternative risk scoring is here to get more people into the system, to help them, not to reject them, that's what exists today. So the problem also should be defined how we can get more people inside the system. It's a little bit different than what the legacies do, that's try to find the problematic, and when you are a company that it's not legacy, you remember that you are opposite. You need to think how you can get more. So we started also to measure the KPI that we put to ourselves, how we can increase first the number of customers, the second one, for each dollar for a company use our technology, how much value we give to them. So for example, what we stand now, for every dollar that a company use our technology, we give them, or they have multiplied $30. So it's a 30x on, so it's a huge metrics. I'm not sure that it's continue like that. Of course, it depends a lot of the companies and the data. And still we do risk assessment, so we also need to see how much we decrease the default rate. So if today a thumb rule that's around 50% of the loss of the revenue of the company become from 4% default rate, so you must decrease it dramatically to have a good revenue and to growth. So today we also look on the KPI of how we decrease the default rate, and it stands on 2.3. So it's around 70% decrease the default rate. So this is how we measure ourselves when we started the company, and that's we want to get more people inside the system.
Awesome. That was really interesting. Thanks for sharing. So you guys will have to forgive me. I'm actually going to go off script here for a little bit. But one thing I'd be really curious on, do you guys see alternative data for underwriting consumer loans as something mostly to get underbanked individuals into the financial system, or do you see it as something that will, continue to be useful as those consumers graduate? Someone has built up a credit history, and then, do you see them migrating over the traditional financial system sort of after that, or do you think there's a future where alternative lending will play a bigger role, either at fintechs or at traditional financial institutions?
I think in my case, it depends how it's going to develop this. But today, I see it as a means of the first entry point, because afterwards, in our modeling list, what you see more relevant is the behavior on actually how you repay your debt. I'm sure that's going to be like that in the future. Maybe we will find new variables that are going to weigh more in the modeling, but today, probably what we see in the first, 5 loans, you will see a big weight on the alternative data, and then behavior start growing in how it impacts the prediction.
I think it's a very interesting question, and I think it's not going to be like one or the other. I think it's going to be like a mixture, right? Because I think given our examples as a fintech, we can't be able to offer any type of loan towards a user, right? Because there's limit in the algorithm that you have is specified for a specific product, right? But if this user that you know is good wants to keep expanding to other types of products and services, that's when relationships with banks and microfinance institutions really come into play on one aspect. But on the other one, if you have a very good user, you definitely want to be able to retain them long term. So I think it becomes like a balance of how do you create the proper relationships with the institutions around for the users to keep improving and be graduating and build their credit towards a point that they are either bankable or can get credit formally. But at the other side, the fintechs and companies like ours will always be striving to offer new types of services and value-added products in order to keep our users engaged and part of the ecosystem that we're creating, right? Because at the end, it's sort of a risk that we're taking, and it's the balance that you have to take in order to optimize.
That makes sense.
I will add here something. I think this question is fit 30 years from now. Today in the world, around 2 billion people, adult, not really have credit history. The legacies will not serve them, and the lenders will, and the new banks, digital banks and things like that will serve them. But it will take some time. So the alternative risk scoring is here and probably will survive at least 30 years, and then probably it will be combined, the models in a way, and a new model with a new technology or idea will jump on and see. So it's an interesting question, but I think for what I see around the world, that we work in many places, the legacies cannot serve most of the population.
That makes sense. That makes sense. Awesome. So moving on here, we'd love to hear now a little about some of the challenges and some of the challenges you guys think that the alternative the companies face using alternative data for underwriting models.
I will start. We don't have challenges. No.
Everything's perfect.
Yeah, work perfect, everything perfect. What we are doing is really blow mind in several places, or people don't really think it's possible. So the first thing is to convince that what we are doing actually work. And to do that, we need to do some pilots with companies with their data. So for example, I need to predict what happened, and the companies can compare what I predict and the historical results. So for me, for us as a company, is the convince in the beginning to give us the trust that what we are doing is good, and our attention is to do a positive thing, and after that we can continue. But the first thing, or the first convince, is the challenge for us.
I think for us, I would add on top what you said, but not specifically trust towards other companies, but building trust with our own users, right? I think anecdotally, when we first started out, one of the challenges that we had at the beginning was people thought that what we were doing was fake, right? Simply, if they have been able to access credit through a very bureaucratic process, it's very tedious, it takes a lot, and then magically they see an ad, and that in a matter of 10 minutes, they can get their credit approved and even money in their account or in their wallets. It's something that really shocks them, right? So for us, building the trust for the user that this is actually a real solution, an affordable solution, something that helps them, is something that we know we have to continue on. Despite the fact that we have already grown, there is a big segment that we're not able to tackle because they are not aware of the solution, and they don't think it's real, actually. So I think that's one of the challenges that we have, is how do you make sure that the people understand what you're offering and the value behind it. And then on the other side, I think, is the educational part. You have to have education on the financial side and on the technology side. And so those two also create a big gap of markets that are not being tapped simply because they lack those skills in order to be able to understand a credit on one side, and then on the other one, if they have a smartphone, be able to apply and use it, right? There's still gap in those two that I think will be challenges for us in how we tackle them, educate people, and bring them forth to these solutions.
I will add one more. We think about alternative data, and you see here we all use alternative data, but we use it on our own. So I think that one challenge we have as a industry or as a ecosystem is how we create means to distribute all this data. And because the data is your own data, so the way you have to do it, and the way we as each country has to work on it, is how we create ways to identify the individual, and how the individual can consent to your service provider, your financial provider, to access new alternative data from different data sources. As for instance, service companies, telcos, all other financial institutions, and how you accelerate and democratize all the data, so each financial institution or each financial provider can access to that data and offer better solutions and better conditions to the borrowers. In the end, that if you solve that challenge, it's going to benefit all the society and all the customers.
That's really interesting. I wouldn't have guessed, for example, there was much of an education problem on the consumer point of view. Totally would have guessed lenders, funders, all those sorts of people. You need to convince them over, but I wouldn't have guessed about the consumers. That's really cool. Thanks for sharing. So I believe we are almost out of time, but if our host will give us another minute or two, would love to answer a couple questions from the audience if there are any.
Yes, hello. I would like to know if there are or if there are any cultural boundaries to your algorithm. So you developed it in Guatemala, for example. How does it travel to other countries, and how can you expand it globally?
Sure. So I think it's important that the infrastructure that you build is similar, one country with another, but the weight of the variables on top of that infrastructure differs, right? And I would say it not only differs country to country, but even within the same country, there are very different ways that regions act, and that's something that the model takes into consideration. So the model should be able to incorporate a lot of the variables and at the same time be very adaptable to understand the differences within the same region or with different regions, right? And it all comes down to the weight of the variables that and the significance that they play in order to determine the credit risk of a person.
Yeah, also among that, like it varies between segments. So if you have a segment that it's underbanked, it's different that is unbanked, and it's different that is banked or has already access. Because one that has already access, you have probably those variables that are available in the market are going to weigh more in the model than those that doesn't exist in the other segments. So it actually changes all the time.
Awesome, cool. Time for one more question. Oh, over there on the left.
So you guys provide loans to other people, but how are your companies funded?
Okay, in our case, it depends on the type of the loan, because you get funded depending on the product. To get funded, you need to get history. It's the same as a person. So if you don't get history, you don't get funding. So, and there is no alternative data to funders. so depending on one of our products, we have a line with our bank, and we use that line because the product has a lot of history, but different products, for instance, in Mexico, we are still on that way. We have a 7-8 month history on the last model, which is working, and we are soon to approach with that product to the bank.
So on our side, initially, similar to what Augusto mentioned, we fundraised and were basically supplied by the equity that we raised initially. But from very early on, we had a lot of focus in building a profitable company. And so given that we had profitability very early on, we were able to tap into other debt facilities like credit lines with banks and such that have been sort of the way that we've been increasing our portfolio, which are those relationships with banks provide us debt that we use then towards providing more credit.
For us, there is a reason why they're called angels. So, by angels. Angels, super angels, and then profit, revenue.
Awesome, awesome. Well, I think we are out of time, so that we'll call it a wrap for today. But thanks everyone for coming by. Hope you enjoyed it, and see you all later.